Hello, in this lecture we're going to talk about International Trade Policy, Chapter 10. We're going to start off with our quote from Ludwig van Mises, who is an economist, and his quote is that manufacturing and commercial monopolies owe their origin not to a tendency imminent in capitalist economy, but to governmental interventionist policies directed against free trade. So what he's saying here is that markets are not tending towards monopoly power. We know that some types of monopoly power can be gained through the companies kind of teaming up with government policy being the thing that is putting in the barrier. And when we talk about monopolies in this instance, we're basically talking about trade, and we're going to get into trade between different countries. So you will see that there's incentives for countries to try to set up policies that will harm trade between countries, meaning we're going to set protective policies. People are going to try to set protective policies so that the local businesses have an advantage. Now, there's pros and cons to that. Most economists are very skeptical of those types of policies because on the overall, trade is good. We've always talked that trade is generally a good thing, and we want to think hard as to whether being an isolationist policies are good or bad when we put those in place. Are we going to be better off or worse off in that? And we'll discuss that as we go. So chapter goals are going to be to summarize some important data of trade, explain policies countries use to restrict trade, summarize the reasons for trade restrictions and why economists generally oppose trade restrictions, and explain how free trade associations both help and hinder international trade. So a quick look about what our exports look like. We're going to just put our exports in terms of who we trade with. So exports being the goods that we trade elsewhere. We produce them, we ship them elsewhere, trade them out. We're going to be, of course, comparing what we produce and what we export compared to what we import, meaning what we produce and kind of like sell or trade with, and what we basically import for added consumption. So when we produce something, of course, we can consume the thing and or we can trade the thing, and these are going to be the exports that we're looking at. So we got OPEC 4%, Central and South America 11, other 10, Pacific Rim, European Union, Mexico, and Canada. These are the areas that we produce stuff to, and then we export it, trading it out. And then if we compare that to the imports, these are the percentage, the pie chart of percentage that we import from. So remember, these are the things that are produced elsewhere that we are taking in, we're producing in order to be able to consume more or different type of goods. So OPEC, Central and South America, other, Pacific Rim, European Union, Mexico, and Canada. The changed nature of trade. So as technological changes in telecommunication reduce costs, foreign countries will be able to provide more services. So this is one of the things that is a little scary to us in the U.S., of course, and it's also a good thing in a lot of ways too. And so notice that in the past, always in the past, there's always been the idea that as the world has gotten smaller, or as communication has been getting better, meaning people can get through the language barrier at different areas, people can get through in terms of better travel time, and of course better ability to communicate by different means. This has always basically increased trade, and increased trade traditionally has always basically meant that overall people have been better off. We're able to consume a lot more today than people in the past. Much of that is due to the fact that we have trade, and trade has been allowed through added communication, better barriers to get through language barriers, and better transportation type of ideas here. So that's continuing to happen now. Now we have better communication in that we can communicate, of course, through the internet, and a lot of the services in that way then that U.S. companies used to have to do here, such as telecommunication services, can now be done abroad more easily now that people abroad, such as India and China, are learning the language of the U.S. language, so that they are overcoming the language barrier. And of course, now we have the technology to be able to provide these services elsewhere. So that could be a con, in that we lose those jobs in the U.S. to people that are more will do them in a cheaper fashion. And then the challenge is if the U.S. will be able to basically specialize and work on different types of things where we have a comparative advantage, and that's going to be the question coming in the future. So the nature of trade is continually changing, both in terms of countries with which U.S. trades and the goods and services we trade. So in the past, when we industrialized, we went through the industrialized age, and when that happened, most of the stuff that we got abroad was just natural resources. We got the natural resources, we shipped them in, then we made the stuff, and then we can kind of ship them out. That's what we were doing when we were in the producing in the industrialized time. Now, of course, we're kind of post-industrial more and more in that we're basically have the producing of stuff is happening elsewhere, and we're doing different types of things, basically a lot of it being in terms of patent goods and intangible type of goods, computer services, and this type of thing. So the nature of trade has been changing. Developing countries are now, of course, India and China being a few, going through the development process, and they're doing a lot more of the production type of activities now. Customer service calls for the U.S. companies are now more frequently answered in India. So that's another outsourcing that has been happening, and the customer and that of course is kind of a bad word, because when we hear outsourcing, we hear basically jobs going abroad. And again, that's very disruptive to most people to see the jobs going abroad. And the tendency when that happens is to say, well, we need to stop that. And the policy, kind of the knee-jerk reaction for the policy to stop that would be, to provide tariffs or to try to restrict outsourcing, to try to tell companies that they can't outsource it and these types of things. That would be one way to try to deal with it. There's costs to that, and usually they're pretty high. And the other way that the U.S. would try to deal with that is to specialize or change what they have a comparative advantage in. We're losing the comparative advantage possibly in those types of jobs, and are we able to shift to an area where we have more of a competitive advantage? If so, then trade would once again possibly work in favor of everybody involved. So we have in Chinese and Indian outsourcing different from previous outsourcing. So using overseas suppliers is not a new development. We've always used development. We've always shipped things overseas. The difference here now is the potential size of India and China. The populations there are just huge. So if the India and China were able to have efficient workers, meaning get to the level of education and level of the language barrier, then just the numbers are a lot bigger than we possibly have dealt with before, and that's going to be the question going forward. How is that going to impact when we start looking at those types of numbers impacting the market? Notice in the past, China's been basically not as engaged with the rest of the world. We've had the language barriers in there and whatnot, and now we have the technology and communication to tap this huge market, and the question is, how will that just sheer size, if it's tapped, affect the market overall? Because technology is growing in these countries, the U.S. economy must develop new technologies to remain competitive. So most economists would say that isolationist strategies of basically trying not to trade with China or India is probably not the best strategy, because what happens a lot of times, and we'll talk about this more, is that we actually become competitively weak, because the companies are only doing well by isolationist policies, by government imposed monopoly. It would be better if possible for the U.S. to find the activities where we have a comparative advantage in, and those are often more entrepreneurial type of stuff, and this kind of more innovation type of stuff, research and development, and these types of things. If we're able to do that, then hopefully that we can actually benefit from tapping into this big market. So that's the question we have. Are we able to shift more towards the things that we have a comparative advantage in, or are we going to not shift and then be competing with an area where there's a lot more competition? So balance of trade. So if we think about the balance of trade, when it comes down to it, it's basically a pretty simple idea. We're thinking about how much stuff we produce, and of course we can produce more or less stuff throughout any given year, but we think, and this is kind of like the income statement if you're thinking about a financial statement, it's how we did throughout the year or some other time period, compared And then we're gonna take that and compare how much we exported compared to how much we imported. And so if we produce stuff, obviously we can either consume it and or we can export it. And if our exports are less than our imports, then we have a trade deficit. So that would be the idea that we got more stuff, we consumed more stuff than we made. And if you think of that as just like your budget at home, it's kind of like, you know, we bought more things than the income that we earned in that particular time period. It's possible to do that because we could have got loans, we could have earned money from the past, but that would be the trade deficit. We have a trade surplus, of course, if we export more than we import. That's kind of like we earned more. If we think of that on our personal finances, that's kind of like we earned more money than we spent it on. And then that means we have some savings. So the country can kind of do that too. Obviously, if we export more than we import, that means we're producing more than we are consuming. So in this case, the U.S. has a significant trade deficit of approximately $820 billion, which is 5.5% of GDP. So when we think of our trade deficit, we've been running trade deficits since like the 70s now, and it's possible to do that, but it is a little worrisome when we start looking at the trade deficits over a long period of time, and 820 billion meaning that we're consuming more. In this case, if we're talking about a household, we're consuming more than we're earning. In this case, similar analogy, we're consuming more than we're producing and exporting in this case, and that's going to run up a deficit. However, if we look at it at a comparison to the GDP, it's not a huge 5.5 piece of the GDP. So that's a bit of a good news on that. So the U.S. is financing its trade deficit by selling off financial assets, stocks, and bonds, and real assets, corporation real estate. So notice that we haven't always had deficits. We've had surpluses in the past, particularly after World War II, at a time when our production was obviously doing better, considering Europe production had substantial problems, considering the war was in that area. So after World War II, we basically had surpluses, and at this point in time, we have a lot of surplus, just like a home. If we had a lot of years of surplus, then at a time when there are deficits, we can run deficits. We can basically spend more than we are making. In this case, we can consume more than we're exporting for some period of time. And then also we can also take out loans if we need to, which we are also doing in order to have a short-term period of consuming more than we are producing. So here's just a graph. The United States has been running a trade deficit since the 1970s. So again, we've been in the deficit area for some time now. But we have had some surplus prior to that we're basically using, and we're also, of course, using our assets. So running a deficit isn't necessarily bad. And again, it's just like a household. It is possible to have earned money in the past and then run the deficit. So the U.S. is currently financing its trade deficit by selling assets. So if we had accumulation of assets that we had accumulated, then of course we could sell the assets in order to consume more, and just like a household could do. And then the U.S. has not always had a trade deficit. Following World War II, it had a trade surplus. So again, there are points and times there's going to be ups and downs. It's just a question of how extreme the ups and downs are. Sometimes countries are going to need to spend more. Usually we need to spend more in times of like war or something like that, because that's when our production is going towards that effort. But there's going to be times when we're going to consume more, and there's going to be times when we can produce more, but we of course have to balance that out over the long run. So the U.S. has gone from being a large creditor nation to being the world's biggest debtor nation. So we were a creditor nation, meaning we had the surplus, and now we're a debtor nation, meaning we've been taking on a lot of debt in order to consume more than we've been producing for some time now. And of course, that's a concern going forward. Where the concern is, we've had some dips, some recessions, and whatnot. When are we going to be able to basically get back to the point where we are producing more than we are consuming? And hopefully that point will come soon.